So, thank you for coming out. This builds well on what Ray was saying about personal inventory and skills. And so once you've built up these skills, and you're always building skills throughout your life, that never stops, you sort of start having to make some decisions which way you want to go. And a lot of people, they go work for a government, they work for a large corporation. Others take a different route and they start working for themselves. So, this is going to build on that and go the route of a smaller business banking. Just to give you a brief introduction about myself, graduated from university, did a science degree, and then moved over to business, did a business degree in master's business. And then I started working for a very small company, 10 people, and basically as a bookkeeper, and then moved off and over a couple of years, moved into a CFO position. It was an owner-operated business, and he was off doing his other businesses as a sideline for him. So I had an opportunity to really dig into a small business and do everything from bookkeeping to putting out orders in the back some days in a warehouse, and accounting and collections and dealing with banks. So as a small business person, you wear many hats. You've got to be able to juggle many balls, and sometimes, unfortunately, you don't look at the key things because you're doing the urgent stuff and not necessarily the important stuff. So it's always something you have to keep in mind. It's very hard to avoid getting dragged into doing the stuff that's hot, but you step away from the big picture sometimes, and it's a big snowball effect. Just let's see, beauty. So hopefully after this symposium, this picture here isn't your history or your future. It's a totally different path, and you're not paying off your student loans when you're 80 or 90 years old. So I think this is a great opportunity to sort of learn right from the get-go. So before you even get into businesses, lots of people have great ideas, and they never quite put them into action. And probably the difficulty is that you procrastinate, you never get the specifics, you always have these general ideas, and one day I'll get to it. To be successful in business, you have to get a business plan going. I was looking at some Industry Canada stats, and for 2009, in 2008 and 2009, 150,000 businesses were started in Canada. So it's a huge number of businesses, and there are over 1.1 million businesses in Canada in general, across the country, whether they're small one-man operations to the multimedia or multi-million, billion-dollar businesses, mining corporations, BlackBerry, whoever. But what's interesting is that in 2009, the analysis was that businesses that were operating for 1 year, 80% survived, 20% failed. Businesses that were operating for 2 years, 72% survived, so 28, more than 1 in 4 failed. And I think one of the critical pieces is they didn't really have a business plan going in. They didn't understand their strengths, their weaknesses, they didn't do the SWOT analysis. And I think business plan gives you a chance to sort of try and focus on what it is you want to do, sort of get your view, your long-term view out there, your strategic objectives. What are your obstacles that you have to overcome? What are your strengths? And it allows you sort of maybe a one paragraph, a one pager, like Ray was saying, a one-page summary of what your strengths or weaknesses and where you want to be with that business. Some of the key points to cover in a business plan, and there's many online websites that tell you how to build a business plan and templates and everything else, but some of the key things to think about is the nature of your business. What is it you're going to be selling? What product? What service? How are you going to be selling it? What are you going to do with those products? What's your competition? What's the industry history? What are those key suppliers? What price points are you going to be looking at? What innovations can you bring to the industry that aren't out there? What's going to distinguish you, again, from your skill set to distinguish you? What's going to distinguish your product or your service from the guy next door? And there's always competition. You may not even know about it, but there is always competition out there. Mm-hmm. So you got to research your market. You got to know who your customers are, who the competition, where are you going to locate? That's a critical piece. Are you going to be a brick and mortar? Are you going to be online? But all that has to be thought out ahead of time. And probably another critical piece is, yes, you have a lot of skills, but you still have to identify some critical resources. You can't be an accountant and a lawyer and a web designer and a marketing guy, and you've got your strengths, but you've got to know who you can turn to for the smaller pieces. And it doesn't have to be a lawyer for multinational type of business, but how do you set up your structure? We'll touch that. Further, what are the key things you have to start from the outset so you don't get into trouble with the government, with authorities, with regulators? There's certain industries have certain regulations. And then probably another critical piece is to set up your projections, your financial information. You start some pro forma balance sheets and income statements, you do your cash flow projections, and you start identifying the investments you were able to put into the business, and you look at your startup costs, whether it's equipment or rent or marketing, advertising costs, web services, your own salary, you have to live off of something. You can, even if you're at home, living at home, or you're sharing an apartment with your spouse or whoever, you still have some expenses you've got to, be able to draw on. So the key to these projections is you've got to be realistic with yourself. You can do sensitivity analysis, but you don't always go on a base scenario. That's the biggest failure of a lot of these business plans, is that people go on a best case scenario. Everything's going to be perfect, I'm not going to hit any obstacles, everything's going to go the way I want. I'm going to make a sale tomorrow, I'm going to make two sales the next day. And some of those things, there's drawbacks. Suppliers slow you down, you don't get facilities from a bank as quickly as you want it, whatever it is. The website crashes for a week, things happen, so you've got to be realistic with those projections. Other mistakes when people are putting business plans together is they have too many ideas. They don't focus on their key priorities. You're better off identifying 2, 3, 4, whatever that is, priorities, and focus on them instead of trying to do 10 things at once at the get-go. Build slowly. And a lot of businesses start off with 1 or 2 customers, which is great, but you also have a plan how to grow that. Customers drop off, customers change. You've always got to be in the market to identify new opportunities and new customers. And ultimately, again, I repeat myself, don't be overly optimistic. Be honest with yourself. So once you've got all that identified, your business plan is put in place, you've got to decide what's the structure you're going to use. And you probably already covered that in your business courses, but you can be a sole proprietor, you can be in a partnership, and you can be incorporated. And each of these have advantages and disadvantages. The sole prop, it's easy to set up, it's very inexpensive, you only ultimately have 1 tax return to make, but the disadvantage is you're on the hook. It's unlimited liability towards you. And any profits you make, they're taxed at the personal income tax rate, which is different from corporate tax rate. And also there's a lack of continuity. As a legal entity, there's no follow-up. If anything should happen to you, you can't sell a business that's a sole prop. Partnership, the advantages are you have somebody to share the burden with, somebody to talk to about things. It's also fairly easy to start. You can have a formal partnership, have an informal partnership, so it's fairly easy, a little more challenging maybe than a sole prop. But the disadvantages, again, it's unlimited liability. In Canada, we don't have LLCs or limited liability partnerships and things like that. And it's challenging sometimes to find a compatible person to do business with. It could be a great friend, somebody you've grown up with and had fun, but when it comes to business, you start not seeing things eye to eye. One wants to grow aggressively, the one wants to be more passive about it. One wants to do this, management styles are different. So you've really got to identify your partner before you jump in. And it's not necessarily the person you're best friends with or somebody you knew for your entire life. It's got to be somebody who has the same philosophy, and that's where that business plan, when you're drafting that, helps to understand whether you guys are on the same page or not. And finally, the other structure is incorporated. It's a much more formal legal entity, but the advantages are that it's a limited liability, the ownership is transferable, you can continue existence, you can leave, you can sell your company, the shares, whatever, onto the next party, you can leave that to your heirs. The disadvantage is much more expensive than partnership. It's not a single tax return. You've got to do a lot of regulatory paperwork. And so you decide which way you want to go. And a lot of people start as a sole prop and then move up into incorporation. Any questions, or am I going a bit fast or slow? It's all good? Okay. So once you've set up a company, you've got to create business accounts. That's one of the basic things. No matter what business you're in, you need a place to deposit your money. You need a place to be able to write checks and make payments, whether it's online or electronically or physically. And there's a few basic requirements for opening a bank account with any bank. Either if you've incorporated, you have to present the certificate of incorporation so that people know who that legal entity is. Or if it's a sole proper partnership, you present a master business license. And again, that gives you the name of that business. And any bank will have to, you can't just be Johnny's play toy. It's got to have a formal registration with the government. You also have to identify the owners. It's sole prop, that's straightforward, but if it's a corporation, you have to identify the owners and the shares they own, percentage of shares they own. And the other thing that they agree upon is signing up. So who's going to be signing on behalf of the company, and if it's 2 or 3 people, is it one person to sign, or 2 out of 3 to sign, or all 3 to sign? And that's something that has to be discussed ahead of time. Once you're committed to that, you can't come in the next day and say, oh, Johnny's not here, can I get some cash out? Banks won't give you that flexibility. Or send your spouse in and say, oh, my husband's on the road, can I get some information about the balance in the account? So you've got to really think that through. You can always make changes down the line, but usually these requirements come up in an urgent situation, and banks don't have that flexibility. They've got to have it on paper because that's what you've just agreed upon. Now, once you're looking at business, you have a business plan together. A lot of companies, they need credit, and there are some key pieces of information that banks require from the shareholders from the business. And from the business itself, it's the purpose of the loan. What do you need the loan for? Is it for working capital purposes? Is it to buy equipment? Is it to buy real estate property, a building? What are you looking for? What are the funds going to be used for? And along with that, you'll need financial statements. If it's an ongoing business and you've been in business for a couple of years, we'll need at least 2 years financial statements and projections as well. If it's a new business, you'll just need some projections, and sometimes you can even actually borrow just based on projections with some of the Canadian government supported loan structures. But you have to have those cash flows projected for 2 years, and again, they have to be realistic. Bankers will look at it and say, you're projecting $2 million in sales. Where's that coming from? And you have no expenses whatsoever. How's that possible? What are you buying? What are you selling? So you have to think that through and be able to answer questions when the bankers ask those questions.
Do you have any suggestions for, building your credit?
Yep, we touched that. You're probably better off, even at this stage, getting a small credit card. Whether it's $500, usually that's the minimum, even if it's guaranteed by a parent or by somebody else, and start working on that right away. Because a lot of people come into the branch, they're 2-3 years out of university, they've never had a credit card, they've never had a car loan, they've never had any of this. And so they don't have bad credit, they just have no credit history. And it doesn't fly very well with the banks. Banks will have, especially for small businesses, it's based on the individual's credit history. That's the ultimate, the source of information. So if they don't have any credit history, it's going to be very hard to start for a business without a credit history. Even if they've never had any losses and they even want a secured loan, they're willing to give you $10,000 for a $10,000 loan. Banks will hesitate to lend because you have no credit history. Whatever your age, and so it's best to start with a small credit card now or a small car loan now, and make sure you pay it. Be on time. That's one of the biggest problems. Is people, the easiest credit these days is getting a cell phone. Everybody gets a cell phone, 2 cell phones, and then they disagree with the cell phone company about the fees, and they say, oh no, that $5 fee wasn't in the contract. And all of a sudden that $5 fee multiplies for 3, 4, 5 months, and they report back, everybody reports back to the Central Credit Bureau type of facility, Equifax, or some other one, and all they do is say 30 days late, 60 days late. They don't say what the amount is, they don't say what, there's a dispute, or there's an objection to paying it. And you look at that and you see, late on availability, and then late on some credit card. You even forgot it. You took it out at a hockey game. They're giving out sweaters or whatever it is, and there was a $5 charge, and you figure, I'm going to ignore that. That's not really mine. It was some startup. That reports again 30 days, 90 days. Now you've got 2 bad ratings, and if you don't check your credit bureau before it goes down too far, that's a permanent record, and those things stay out there for 7 years. So you're better off either making sure you have that dialogue with the cell company or the credit card holder, whether it's a business card or a department store card, whatever it is. Have that dialogue, make sure that record is clean, and they report back to the credit bureau that yes, it was a dispute and it's been settled. or whatever it is. But if you have a write-off or even $20, people don't look at the dollar amount, they just see that, oh, didn't pay this bill, had a write-off for $20 here, bad credit history. And it could be something that's out there for 7 years. So you got to be very careful. It's very hard to repair a bad credit history. But that's a great question. Okay. So aside from the information about the business itself, we also look at, as I mentioned, the owners. Those are, especially in small businesses, everything's riding on the shoulders of the owners. So we look at the capacity of the owners, but we also look at the personal net worth statement. What are the assets that the owner has, or the owners have, in bank accounts, investments, is it a house, is it a car, and what are the liabilities? So credit cards, student loans, car loans, what mortgages, whatever it is, and you hopefully are in a positive on those. And then we also look at the revenue that they generate. So the notice of assessment, the tax returns for the last 2 years, just to understand their capacity to repay, and the credit bureau, which is probably the most critical piece of information. It's the track record from many different sources. So we asked for those 3 pieces of information every time. And the reason we ask for that is we look at 3 characteristics: the character, collateral, and cash flow, which is debt servicing. So the character, it's the individual. What's your experience? What's your capacity? Are you able to present the business plan properly? Do you have a real understanding of your industry? Bankers don't know every industry. There's so many different things out there. You never are aware of every industry, but you certainly can understand who knows their business, who's comfortable with that business, and somebody who's just floating and guessing with how it's going to work. So when you come into a bank, you have to be prepared. It's like an audition or a job interview. You got to come in prepared, and you may not have every answer, but you better not try and float through it either. If you don't have an answer, be upfront about it. It's something thanks for that question, I'll get back to you. I've got the information at home, whatever it is, but take down the notes and get back to the banker. The next is collateral. So we're looking at the business assets. What are the business assets in a business, whether it's equipment, or if it's receivables, if it's inventory. And we're also looking at the individual's assets. Do they have a home? Do they have investments? A lot of times, especially in startups and smaller businesses, we're going to be going on a fully secured basis. We're going to get personal guarantees from all the owners, and we're going to be getting some sort of collateral, some liquid collateral, some mortgages, whatever it is to support the business. It's very rare, unless it's a really strong guarantor, that will be on an unsecured basis. And aside from the collateral, we also want to determine the ability to repay. Banks don't want to be collecting on collateral. They don't want to go and seize a home or seize a car or seize whatever piece of equipment. So we look at the revenue streams. That's why we ask for the notice of assessments and financial statements, just to see the capacity to repay. So we look at the revenue, the gross revenue, and then you deduct all the other credit requirements, whether it's a mortgage or a student loan or a car loan, and then see what's net, what's left is enough to cover your own capital and interest repayments over whatever time frame. So those are the 3 critical pieces. And in terms of loans, there's basically 3 types of loans when you get down to it. It's a line of credit, which is for short-term credit requirements, and it's usually done on an overdraft basis. And it's for things like buying machinery, or not buying machinery, but buying inventory, and then it takes 30 days to produce it, sell it, and get a receivable in. So it's meant to fluctuate and turn around very quickly. Then we have more business loans, which are for buying equipment, or maybe for some startup costs that right at the outset that you're going to pay back over a period of time, as that the computers or the manufactured equipment or a truck or whatever it is will generate revenue for you over some period of time. So it's over set out period of time, set out term. And then there's business mortgages, which is to purchase real estate typically, or land where you would be operating from, or it might be an investment for that business. And then, aside from credit, banks offer other services such as merchant services, which is the ability to accept credit cards and debit cards as payment. And there's many different service providers, but you got to be careful to make sure you have a quality provider, because the worst thing to have is you're out at somebody's door trying to collect and the machine doesn't work. Now they don't have cash, and you have to make a decision how you're gonna either leave the product there and come back and pay, collect later, get a check, and may or may not be good, so you have to make sure it's an effective provider. Payroll services is another thing that people typically will think they can handle, but it's complex these days with the elections at source and various provisions and T4s, so usually it's best to get a payroll service out there to do that work for you, and you can concentrate on your core business. Investment solutions, as you build up your equity and you build up your savings, how do you invest those funds in a safe manner but yet get a good return? And cash management services, so electronic transfers, wire payments, etc. So there's all sorts of cash management, FX transactions, things like that. So cash management services are all provided by the banks. And that's it. So if you have any questions or anything else.
I have a question.
Yeah.
At the beginning of your presentation, you mentioned some statistics on probabilities of business success. So if what in your estimation is the probability of success for a young entrepreneur to have a business start up and succeed? Do you think it's very, very good or very, very impossible, or on a scale of 1 to 10, how would you rate it?
I think if whoever it is, but young or older or experienced, less experienced, but they go in with their eyes wide open, if they really do their homework ahead of time, I think they can be ahead of that curve. You know, the 20% failure rate in the first year, it's typically guys who don't even have an idea of what they want to do. And what's really interesting is there's a 20% failure rate, but the actual bankruptcy rates, where actually people go out and owe more money than they have, is very small. It's 6% in the worst case years. You know, after any crash or you know, the 2004, 2005 period, all those, you know, Lehman Brothers went out of business. Even at that point, the bankruptcy rate is very small. So most people just go out of business. They don't really lose any money, or they don't, you know, have outstanding debts. So it's not hard to be successful in business as long as you're not overspending, not hoping that tomorrow I'll get $10 and spend it today. You know, be overly aggressive. Be realistic and make sure you have the capital base to be able to generate some time before you can start seeing the returns. That's it. So thank you guys.
Thank you very much, Mr. Anatoly Gann.
My
That was a
pleasure.
fantastic presentation. We appreciate you offering your time and your contribution and all the effort that you put into your PowerPoint.